Welcome to Cashflow Positive. Have you ever considered refinancing your mortgage? That's a question our friend John has been pondering lately. John is an everyday homeowner, just like many of us. He's been diligently paying off his mortgage for a few years now, ticking off each month as he gets one step closer to owning his home outright. But recently, a friend mentioned something that piqued his interest: mortgage refinancing. So, what exactly is mortgage refinancing? Well, it's a bit like swapping out your old mortgage for a shiny new one. You take out a new mortgage to pay off the old one, and you're left with a fresh set of terms, possibly a new interest rate, and potentially a new plan. John's friend told him it could be a way to lower his monthly payments, or perhaps shorten the term of his loan. Or maybe he thought it could help him switch from an adjustable rate mortgage to a fixed rate one. With all these possibilities swirling around his mind, John found himself at the heart of the mortgage mystery. But here's the thing about mysteries. They're not always as complicated as they seem. Often it's just about finding the right clues and piecing them together, and that's where we come in. John starts his journey by researching what mortgage refinancing is all about. Mortgage refinancing, in its simplicity, is like a do-over for your mortgage. It's about replacing your existing mortgage with a new one, typically with a lower interest rate. It's like having a reset button, and who doesn't love a good reset button, right? Now, why would someone consider going through the trouble of refinancing their mortgage? Well, there are a few reasons. The most common one is to reduce monthly payments. Imagine you've been paying a hefty sum every month for your mortgage, and suddenly, you find an opportunity where you can pay less for the same thing. It's like finding the same pair of jeans you've been eyeing for a while at a discount store. Another reason people consider refinancing is to shorten the loan term. Let's say you borrowed for 30 years and you're 10 years into it. But now, you're in a better financial position and can afford larger payments. You can refinance to a 20-year loan and save on interest. It's like stepping on the gas pedal on a highway when you realize there's no traffic. Lastly, some people refinance to tap into their home equity. This is like having a piggy bank built into your house. As you pay off your mortgage, you build equity, which is the difference between what your home is worth and what you owe on it. Refinancing allows you to tap into this equity, giving you access to a large sum of money. But here's the catch. Like any financial decision, refinancing isn't always the best fit for everyone. It's like choosing a pair of shoes. Just because they're trendy doesn't mean they'll be comfortable for you. John now understands the basics, but he's still unsure if it's the right move for him. To make his decision, John decides to weigh the pros and cons of refinancing. First up, let's talk about the potential benefits. Refinancing could lead to lower interest rates. Imagine this. John's original mortgage was at a 6% interest rate. However, current rates have dropped to 4%. By refinancing, John could save a substantial amount over the life of the loan. And it's not just about the long term. Lower interest rates could also mean lower monthly payments, freeing up some cash for John to use elsewhere. Secondly, refinancing could allow John to tap into his home equity. If his home's value has risen since he bought it, he could access this increased value and use it for significant expenses like home improvements or to consolidate higher interest debt. This is known as a cash-out refinance. Now, on to the potential downsides. One major consideration is the closing costs. Just like when he got his original mortgage, John will have to pay fees when he refinances. These could include appraisal fees, origination fees, and more. Depending on the size of the new loan, these costs could be substantial. Another potential con is the possibility of extending the loan term. If John chooses to refinance his 20-year mortgage into a new 30-year loan, he'll be making payments for an extra decade. This could mean paying more in interest over the life of the loan, even if the monthly payments are lower. And let's not forget, refinancing requires a solid credit score. If John's credit isn't up to snuff, he might not qualify for the best rates, or he could be denied altogether. John realizes that refinancing is a complex decision and he needs to consider his unique circumstances. Every homeowner's situation is different, and what works for John might not work for others. It's crucial to weigh these pros and cons carefully and consider seeking advice from a financial advisor before making the decision. With all this information, John is ready to make his decision. Our friend John has been on quite a journey, hasn't he? From unraveling the mortgage mystery, grappling with the dilemma, to weighing the pros and cons, he's been through it all. Now, it's time for the final act, making the decision. Just like John, every homeowner must consider their long-term plans, current mortgage terms, and financial situation before deciding to refinance. It's not just about the numbers, it's about your life and your future. Firstly, let's talk about long-term plans. John, for instance, plans to live in his house for the next 10 years. For him, refinancing to a lower interest rate would make sense, as he would have ample time to recoup the costs of refinancing through the savings on his monthly payments. But if John were planning to move in a couple of years, the costs of refinancing might outweigh the benefits. Next, consider the current mortgage terms. John's original mortgage had a high interest rate. By refinancing, he could potentially save a significant sum over the life of his loan. But if John already had a low interest rate, the savings from refinancing might be minimal. Lastly, it's crucial to evaluate your financial situation. John had a stable job and a comfortable emergency fund, so he could afford the upfront costs of refinancing. But if he was living paycheck to paycheck, the immediate costs might have outweighed the long-term benefits. In the end, John decided to refinance his mortgage. He had a long-term plan, his current mortgage terms were far from ideal, and his financial situation allowed him to bear the upfront costs. But remember, this decision was based on John's unique circumstances. John finally makes his decision, but remember, what worked for John might not work for everyone. Each homeowner's situation is unique, and what works for one might not work for another. So when you're deciding whether or not to refinance, take a cue from John. Consider your long-term plans, your current mortgage terms, and your financial situation. Only then can you make a decision that's truly right for you. Refinancing your mortgage can be a beneficial move, but it's not for everyone. A statement that rings true for many homeowners. As we wrap up our discussion on mortgage refinancing, it's important to reiterate the key points and considerations. Firstly, mortgage refinancing isn't a one-size-fits-all solution. It's a financial strategy that can provide significant benefits such as lower interest rates, shortened loan terms, and the opportunity to tap into your home's equity. However, it also comes with its own set of drawbacks like possible closing costs, extended loan periods, and the risk of falling into negative equity. The decision to refinance your mortgage should never be taken lightly. It's a move that demands careful thought and a comprehensive understanding of your financial situation. You need to consider your current mortgage terms, the prevailing market rates, your long-term financial goals, and your ability to meet the potentially higher monthly payments. Is your best friend in this journey? It's crucial to shop around and compare different lenders, as the terms and rates can vary significantly. Online mortgage calculators can be a handy tool to help you estimate your new monthly payments and the total amount you'll pay over the life of the loan. Remember, refinancing isn't always about getting the lowest interest rate. It's about making your mortgage work better for you. This could mean switching from an adjustable rate mortgage to a fixed rate one to enjoy more predictable payments, or opting for a cash-out refinance to fund a major purchase or consolidate high-interest debt. Your individual circumstances, needs, and aspirations should guide your decision. It's about striking a balance between the potential benefits and the inherent risks. Consulting with a financial advisor or mortgage specialist could provide valuable insights and help you make an informed decision. Remember to always make informed financial decisions. If you enjoyed this video and found it, please hit the thumbs up button, subscribe to Cashflow Positive, and share for more interesting facts on finance. Your support really helps the channel.